Hello all and welcome back. All right, I got a lot planned for this video. It's kind of like two videos squeezed into one. Now, before I get started, I just want to wish everybody a happy New Year's. A big shout out to Bob and Dave and Chuck Brown for consistently leaving comments and hanging out with the channel. I definitely appreciate that. And then it's a small channel, so I notice when the subscriber count goes up, even if by one. And so cheers. Thanks a lot, Smetters. Jack told me that you were the one that subscribed last week. Much appreciated. And just just a big thanks to anybody else who just checks out the channel. It's definitely appreciated. I need you more than you need me, because when I talk about finances to my circle of friends, their eyes roll in the back of their head. My wife leaves the room. Like, nobody wants to talk about it. So hopefully this is my avenue to try and get some finance talk out into the world to someone who might actually care about it. All right, so this is the time of year where everyone makes their big market forecast for the upcoming year, and right now, it's January 1st, 2024, so it's the 2024 prediction. And right now, there's a lot of good news being priced into the market. And you got these analysts that come on television and they're like, "Oh, I think the market's getting way ahead of itself. We're pulling forward a lot of good news." Yes, of course the market is getting ahead of itself. That's what the market does. It's how you make money in the market. If you wait for good news, then you missed the market, right? So you missed it. So yeah, it's getting ahead of itself and it's pricing in the rate cuts. And this could be dangerous, as people could be caught off sides. You could be putting all your money in there and then the rate cuts don't happen. And it would be like the opposite of last year. Last year, everybody was caught off sides because there was this big recession call, and understandably so, because the Fed came out and said, we're going to cause a recession this year. And so everybody was expecting the market to have a bad year in 2023. Well, almost everyone. What I'm saying is that in a market cap weighted index, which is what the S&P 500 is, if all of the top ones are already down 30 to 50%, you tell me how the S&P 500 is supposed to crash when these big companies have already crashed. But thanks to strong consumer spending, that recession just didn't happen at all. So like I said, this year the market is pricing in about 6 interest rate cuts. Even though the Fed's only said they're going to do 3, the market's pricing in 6. And if that doesn't happen, then all the fun that we've been having the last few months or so, it's going to be unwound in the first few months of 2024. And could that happen? Well, sure. I mean, anything's possible. The market goes up, the market goes down. But I'll weigh in with my opinion on what my expectations are for the coming year. And I'll tell you why I feel that way. And after that, I've got what I think is a very interesting video, and it's from Jim Cramer. And regardless of how you might feel about him, he's been doing this an awful long time. He knows a lot about the stock market. And in his video, he talks about how he trades his long position. So he finds a company that he really likes, and then he buys that company. Then he trades around that position to try and maximize his portfolio gains, where he's not just completely reliant on the stock just continuing to go up, up, up. There are ways that he goes about it to try and make money on a trusted long position without really selling out of that position. I do it a completely different way than he does. We'll first look at that video, talk about his way, and then I'll show you my portfolio and show you how I do it. Now, in order to do this sort of thing, you're going to need to really pay attention to the market. Not everybody's that in tune with it. Like, the advice I give my daughter, because she doesn't really watch it that much, I tell her just buy SPY or VU or some sort of S&P index and just put money in there every couple of weeks. And she's like 21 years old, and so over the course of your lifetime it'll go up. And let's say that the whole thing crashes and it doesn't go up. Well, that means the world is coming to an end and it doesn't really matter anyway. So just go ahead and put that money into SPY or VU if you don't like, follow the market. But if you do like to follow the market and you do think that you've got a really good stock that you like to keep for a very long time, I can show you how I like to trade that position, and Jim Cramer will also show you his views as well. So what do I believe that we're headed for in the coming year? Well, last year I held a pretty contrarian view to what most people were forecasting about the market. But this year I tend to be with the masses. I do think the market will be up. But before we discuss that, let's first discuss some of the bear case type of stuff. Let's just get it out there. Because right now we are seeing evidence of an economic slowdown. The Atlanta Fed came out and they predicted that the GDP for Q1 is going to be up about 1.2% versus 5.2% last quarter. So it's slowing down. And the Atlanta Fed is also a pretty optimistic group of people. And they're predicting a slowdown there. We've had unemployment go from 3.4% up to 3.9%. The Fed, in their summary of economic projections, predicts it will go up to about 4.1%. So they're still expecting more joblessness to come. We see job openings are down, month over month. It's just consistently coming down, down, down. We're seeing continuing jobless claims. They're on the rise. But probably worse than any of that stuff is this home affordability. All right, so right now the median income for American couples living in the United States is about 75,000 a year. Now they're saying if you want to put 20% down on an average price home, that couple needs to make $110,000 a year if they don't want to spend any more than 30% of their income on their mortgage. And so what's happened is that now we have the worst home affordability since 1984. We're going to see that mortgage payments, if you put 20% down on a $400,000 home with a 6% rate is $1,918, 8% rate is $2,348 a month. It's a big difference, a difference of $430 a month or $5,160 a year. Now, all of this seems pretty bad that's bad news in an election year. And only one thing is going to right this ship for the incumbents, right? And that's going to be rate cuts. So that's kind of why I'm kind of betting on these rate cuts, because that's the only thing that's going to fix this. Now, if you look at inflation over the past 6 months, annualized out, I think it's about 3%, but it looks like the inflation is coming down, and many would say that the war on inflation is basically over, and that's why we can do a bunch of rate cuts. But because of this home affordability problem, I think what you're doing is you're alienating a lot of millennial and maybe Gen Z type of voters. So this would be the group of people that would be most likely to vote for the incumbent rather than want to change. And so, but what they've done is they've alienated this group, and so things are swinging in against the incumbent party right now. So I think that really, in an effort to try and recapture what would be traditionally their base, at least in this at this time, I think that the only thing they can do is lower these interest rates and allow home affordability, allow people to be able to move into homes. Because no matter how much you say inflation is down, if they can't afford a home, they're just going to tune you out. They're just not going to believe you. So do I believe we're going to get rate cuts starting in March? Yeah, I do believe it. And I think that it's going to happen regardless of what the incoming data looks like. We're going to start seeing these rate cuts, and I believe it's probably going to be political. But it could also be based on inflation data. We'll get into that in just a second. Now, this week coming up, we've got the JOLTS report. I think it's on January 3rd. That's coming out, job opening, labor turnover survey. And this is always a terrible day for the market. It's always a terrible week for the market when this jobs report comes out, because bad news tends to be bad and good news tends to mean we're not going to have rate cuts. So that's bad too. So there's really no good outcome for us. The best we could hope for is just basically flat. But that's going to be this week. So this week could be pretty rocky, and everybody says, I knew it, the calendar changed and things are not good anymore or whatever. But just kind of just steady the ship and have good investments and don't worry about, well, I'll show you how to trade around your long positions in this video, at least how I trade around mine, and I can show you how Jim Cramer does around his to keep things kind of on the smooth and steady. Now, like I said, there is a bunch of evidence that the economy is slowing down, and there's definitely the possibility that we could have the economy could slip into a recession this year. But what does that mean for the market? Does that actually mean that the market will come down if we slip into a recession? And in my opinion, a mild recession will do almost nothing. And I don't have to like look any further than my own personal portfolio, because I've got a lot of cash just kind of waiting there for like a 5%, 10% pullback. I'm just kind of waiting for I'm kind of pick my spots where I'm going to get into the market again. Well, I'm already in the market, but where I'm just going to put hold a much smaller cash position, let's put it that way. And there's also like $6 trillion in cash in different uh, funds or whatever, just kind of sitting on the sidelines, and they're also waiting to get in the market as well. So any pullback that happens in this market, I think, is going to be quickly bought up. So it's going to be very hard for this market to really have some sort of substantial crash unless the recession is really bad, unless unemployment goes really up, GDP is just really, if it's a bad recession, yeah, the market will go down. But if it's pretty mild, I see us buying the dip is what I kind of see happening for the current year. And that's the way I see the market going forward in the coming year, is that I believe that we're going to buy the dip. Okay, so what do I expect is going to happen with the housing market? So with all of the rate cuts that I believe will come into the economy and over the coming year, I I think that basically your millennials and Gen Z and people like that trying to get into new home, your first time home buyers, they're going to be able to start buying homes at the end of 2024. And this should carry right through 2025. And that's kind of like my prediction. I think that basically the rates should be around 4.5% by the end of 25 or something like that, 4%, 4.5. And they'll be able to get into homes again, and things will seem a lot better. And that's my prediction for the housing market. And that's why I've actually got a small position in ITB, which is a home builder ETF. And should it not go that way, should the rate cuts not happen, it's an ETF. So, if it comes down, it's not going to fall down in a straight line. It'll be kind of gradual. I'll see the news coming in, don't really like it, down about $4 or $5 a share, sell out, I'll be fine. So I'll finish up by saying that the market is up, most years. It's up about 70% of the time. And if for no other reason, I think the market's going to go up this year because the odds are just in my favor. It's just what happens. The market just kind of seems to go up. And I can bet against the market if I like, but in the long run, with a 70-30 split between good versus up versus down, or good versus bad, I'm going to be ending up a loser if I consistently bet that it's going to go down. So yeah, I do believe we're going to have an up year. I believe that 10% seems reasonable. Like I said, I think 5,200 for S&P at the end of the year is a perfectly conservative view, and I do think it's going to be just fine this year. And also, I think that the big stocks, and when they say that outperformed last year aren't going to perform this year, I still see them, the big stocks, doing just fine. I think that Microsoft's going to have a good year. Nvidia is going to have a really good year. My take on Nvidia is this: they were up 220% last year. Well, that's because their revenue and their profits were up 220%. This year, they're expected to be up 20 to 30%. I expect Nvidia to be up 20 to 30% because their stock price is going to follow their earnings growth. And so that's my big stock that I like personally. I'm sure you guys have your own, but for me, my number one pick is Nvidia, and I have about 5 stocks, 2 ETFs and 3 stocks, and I don't know. I'm going to roll with that for right now, and a whole lot of cash, and I'm just going to wait for a pullback, and I'll just start putting money in as the pullback happens. And I'll tell you when I think it's going to happen. So I do expect there to be a bit of a market pullback here right around this week right here of January 11th. The CPI report's going to come out. I don't expect that number, the annual inflation, is going to go down. I think it's going to be flat or maybe slightly up. But if you look at it here, last month we were 0.1 month over month. The month before that was 0. And then we had a pretty big month here in August, which was 0.6. But if you extrapolate the last 6 months, it's 3.0. Over the past 12 months, it's 3.1. So we seem to have really settled in here in the 3% range. The Fed ideally would like to get it down to 2. And it does seem like we could be headed in that direction. Food should be flat. Energy continues to just fall. Bad news for Tesla. But yeah, oil prices just keep on coming down. let's see, the housing index here, it went up surprisingly last month. I would expect that this would tick down again. Like we said, home affordability has more people like renting, multifamily and stuff like that. So rents are coming down. What happened was that these big home builders built a lot of multifamily homes. And and so now we have a bunch of them and they can't rent them all out. And so we have too many, and that's what's bringing down the rental prices. And that should be filtering into the economy soon. And so I would expect this to come down. And this is 40% of the weighting of this entire index. So I would expect that month over month, it's not unreasonable to think that we would be 0.1 again. It could be flat. But so if we look at this and we do 0.1 month over month, that would get us to 307.917. Multiply that by the 0.1 month over month, and that gets you there. And then divide that number by this number here, that 298.990. And then month over month or year over year, we would have an inflation rate of 3.1. Now, it was 3.1 last month also, so it wouldn't have gone down. The inflation forecast right now is expected 3.0%. That's a pretty low bar to hit. What they're essentially saying is they believe it's going to be 0 month over month. So if you take in 307.917 and you divide that by this number right here, 298.990, that gets you to the 3% that they're talking about. And so they're expecting this number here to be flat month over month, and that's a pretty heavy lift, in my opinion. Other than that, we're talking about deflation. Maybe that shelter index brings it down, but 0 seems pretty small. But 0.1 seems like it could be a disappointment somehow. But annualized, it'll be 3.1%. Now, this might scare people into thinking that rate cut in March isn't really coming. And so the next place that I expect that the market could pull back is going to be right around that March timeframe, because there's going to be a lot of people scared that rate cut isn't coming. I happen to think that it is, and I happen to think, not to get all conspiratorial here, but I happen to think it's going to be somewhat political, if not entirely political. Well, somewhat political in the sense that the incumbent party wants to stay in power, but also inflation is coming down, and that was the plan all along. So you're going to probably listen to people giving you both sides of that story, and neither side is going to be entirely wrong. So it's going to be one of those circular arguments, if you will, and something I'd just soon not get into. All right, so let's discuss how to maximize your returns by trading around your long positions. And so what we're trying to do is we don't want to be just reliant on this stock just going to the moon in order to make money. We're trying to figure out ways to make money even if it stays flat in the long run. I'll show you the Cramer video that I talked about, and then and that's going to detail how he does it. And then I'll discuss the pros and cons of how he does it. And then I'll show you how I do it with my portfolio. And neither way is wrong. Like I said, Cramer, think of him what you will, but his opinions are valid because he's been doing this for a really long time. And although we do it very differently from each other, the idea of trading your long position to maximize your gains is an ideology that we share. So let's go ahead and check out this video.
Regular viewers know that this show's all about investing, owning stocks for the long haul, not really short-term trading, because it's much easier to be a good investor than to be a good trader, especially when you're doing it part-time. However, knowing how to trade makes you a better investor, and trading around a core position is one of the most basic and useful disciplines out there, especially in markets that often get hit by wild swings. And that's most markets in recent years. So what does it mean to trade around a core position? Okay, let's go through it step by step. First, you need a stock. Pick one that you like, one that you got an opinion about, one where you have a bias, a stock you believe is headed higher over the long term. What you're really searching for here is a great company with shares that might get tossed around by market volatility, even as you believe they'll ultimately go higher if you're patient. Now, if you were just investing, then you just set up a position in the stock, buying in gradual increments, because we all know that buying all at once is just pure arrogance, and that'd be it. By the way, this whole process of buying in increments is something that we're constantly showing you how to do if you belong to the CNBC Investing Club. We also talk about trading around positions. Take something like NVIDIA. That's a chip maker with a fantastic long-term story because they make the most powerful semiconductors on Earth that we needed for cutting-edge applications like artificial intelligence. I love NVIDIA for the long haul, but it's got an insanely volatile stock. Now, let's say you want to own 100 shares of NVIDIA over time. Then the way to set a position would be buy 25 shares 4 times over a period of weeks or even months. And that's your core position as an investor. But let's say you want to trade, something that's hard to do, but also cheaper than it's ever been. Because home gamers can now fit in, they can fit in and fit out, no stock commissions. Now, I wouldn't recommend pure trading something like the NVIDIA. My stance is own it, don't trade it. But trading around a core position, different story. So let's go back. You own the 100 shares of NVIDIA. And let's assume it's sitting at, I don't know, how about $50, $500 for the purpose of it. It's $500. Every time the stock jumps another 5%, you could sell 25 shares, a quarter of your position. You shave a little off to bring in some profits. So once NVIDIA hits 525, you'd own 75 shares. You keep scaling out the same way on the way up, but don't ever sell the final 25 because that is your core position. Then you wait until something happens to knock the stock back down, and as long as nothing's changed with the underlying thesis, you use that weakness to stock up more NVIDIA. We've done this for the Travel Trust. It's going to happen pretty often because, see, since we're in a world where stocks can get crushed by all kinds of factors, nothing to do with fundamentals, that's what happens. Now, as the stock comes down to the original cost basis, you buy it back in increments. Since we started with 100 shares, let's keep using increments of 25 to buy it back on every 5% decline. You can go beyond 100 shares if it comes down low enough, too. Now, this might appear to be small potatoes, up 5%, sell 25 shares, down where you started by 25 shares, and repeat the process on the way back up. But over time, your profits will add up, and that's what trading around a core position is all about. Now, a lot of people think trading is incredibly exciting, and it can be. But if you're good at trading around a core position, you should be pretty bored. All you're really doing is watching the stock move and then trimming or adding your position accordingly. Contrary to the image of trading as something that's reckless and irresponsible, trading around a core position is really the height of prudent portfolio adjustment. Boring, by the way, is good in this business. Exciting? Save it for the stadium. Obviously, you can scale these numbers depending on how big your position is, but the basic idea is avoid putting yourself in a spot where you have too much on the table in case the stock gets swatted down, or too little on the table to take advantage of any upside that comes your way. Trading around a core position is an important basic strategy that everyone can use, even those of you who find the notion of trading totally abhorrent, because it's less trading and more just a supplement to investing. So here's the bottom line. Now you know the basics of how to trade around a core position. Yet another method to my madness, one that allows you to generate lots of small gains that I am telling you will add up over time.
And having small gains add up over time while trading around my core position, that's my strategy as well. He and I do it differently, but that is also my strategy. And it also looks like Cramer, he likes NVIDIA too, because that's what he talked about in that video. But that's also my core position. That's the one I have the strongest conviction in. It's not necessarily the stock, and it's absolutely not going to be the stock that goes up the most next year. It might only go up like 20 or 30%, we'll say, based on what, predicted revenue growth, right? But then there's going to be some that go up 300, 400%. I'm not interested in those. I'm not interested in high flyers or stocks that are just kind of like really gambling. I just want like strong core stocks that I have a lot of conviction in to do this with. Now, unlike Cramer, when the stock shoots up, I don't sell my long core position that I have a lot of conviction in. And the reason why I don't is he likes to sell it, and then hopefully, when it goes up, and then hopefully when it comes back down, he'll buy it again. But you don't always know that that's going to happen. In the meantime, he might be stuck with a quarter of the position that he wants, and the things run away from him. By the time he buys it, it's a lot more expensive than what he sold it for. So, it's a method that works for him. I'm sure that he knows what he's doing, that he makes it work, but it's not one that I do. It's not one that I've ever tried to make work. I have my ways and he's got his. Let me go ahead and show you my method right here. So here's my trading portfolio right here, and this is how I go about it. I do it by selling calls and selling puts. When the market goes way up, when my stock goes way up, Cramer will sell out of his stock. What I do is I'll sell a call. So on a really good day, I'll take the opportunity to go ahead and try and make a little extra money off my long core positions by selling calls. So here, after NVIDIA had a particularly good day, what I did was I sold 2 calls with a strike price of $507.50 that expires next Friday. I collected $868 in premium. But also, you might remember a couple of weeks ago, the whole market took a plunge. On those days when the market takes a huge plunge, Cramer would then go ahead and buy back his core position, but I don't actually do that. What instead I do is I sell puts on those days. So what happens is that I create a strangle, which a strangle being like selling a call and selling a put around my core position. And this strangle's got quite a big middle ground where I can win here. What is that, about $37.50? And so what this one here says is if Nvidia falls below $475 by next Friday, I will buy Nvidia for $475 a share. However, if it's above $475, say $480, I'll keep your $324 and I don't have to buy any shares. This one here says that if by next Friday, if Nvidia is over $507.50, I will still sell you all of my shares of Nvidia for $507.50. But should it be $500, I get to keep all my shares of Nvidia and I get to keep your money. So, and that's the way I trade this. Now, the one, when the day then it, like when it really plunged Nvidia, I sold one quickly on that day. This is actually, and collected about 400 or so on that one, but this is a different one from another day. But before we get into the Nvidia position, which is pretty large, let me just demonstrate what I'm talking about on one of my smaller positions. Let's say SMH. So SMH is a new position for me. It'd be a new long core position that I'm basically trading options around. I bought it on December 19th for $173.78 a share. And what I've done since the 19th, we'll say, is sold a lot of calls and a lot of puts against the underlying. So I'm trading around this long position to try and make a little extra money. In doing so, I brought my cost basis down to $169.95. So I made almost $400 in the last couple of weeks trading with this asset. Now, I'll give you an idea of the sort of thing that I might do. So on the 26th, I sold a call for $182.34. But then I ended up buying it back for $161.66. So I didn't make that much on that one. I only made $21. But what it allowed me to do is set my strike price from $177.50 all the way up to $181, and that one expires in 2 weeks, in 2 Fridays from now. But I was able to boost the strike price up even more, which gives me a whole lot more chance to make a little bit more money, but just importantly, keep these shares because I'm not looking to dump these shares. And right now, I don't have a strangle on SMH because it hasn't really had that big dip yet. It just kind of goes up a little bit every day. Here'd be like Goldman Sachs. I'll have to do a custom on this one because I feel like I've owned this in the past. So on December 14th, I bought Goldman for $379.68. The lighting's kind of weird in here right now. I have to put on some glasses. I actually got these. My wife got these for me for Christmas. So it's like on my keychain and just like blip, like that. And then I got little readers that go on there. So they're by, in case anybody wants them, they got a good present. Let's see, by Thin Optics, a good present. Anyway, they're readers that can go in your pocket on your keychain. But I digress. All right, yeah. So I got Goldman for $379.68. But since then, I've made some money on Goldman. It looks like I've made, well, now I have it for $376.66. So I made about $300 on Goldman. And ITB was another one. Let me see how I've done on that one. I've never bought that one before, so I don't need. So I got ITB for 101.39 on the 20th of December. And if I include my options on this one, my new per share price is $98.78. So I've made a couple hundred on that one. But this is how I trade around my core positions. Oh, let me show you NVIDIA. So NVIDIA is one that I really work this one. I love NVIDIA because, see, it's very, very volatile. Just like Cramer said, super volatile stock. And so for that, you get a lot of premium and you can sell things way out of the money, either up or down on NVIDIA. So if I look at NVIDIA over the same exact time frame here, and I don't include options, I bought NVIDIA, it looks like for, it's like 95,142. If I divide that, 95,142 divided by 200. So I got it for $475.71 a share. But if I include all of the options I've been trading on, and this is going to be a pretty staggering amount of options here, I imagine, because I trade this one an awful lot. Ooh, dividend. I didn't even know you got dividends on that. My cost per share is, goodness, $90,307.75, and this is since October 18th. So 90,375 divided by 200 equals, so my cost per share goes from 475 to 451, because every time I make money on it, it takes cost per share off. So in the last couple of months, it looks like I made what's that, 23 times 2, $4,600 in options off of Nvidia. Not to mention the fact that Nvidia, I had it at 475 a share when I bought it. It's now up around 495 a share. So there's another 4,000 or so dollars right there. And that's how I can trade my core position on Nvidia. So on this one, I'm actually doing pretty well. It looks like I'm up about, I guess, about $9,000 or $10,000 on this one since October. So that's how I trade around my core position. And that's how I maximize my gains with the stock market around my core position. But I only can do this with stocks I have a lot of conviction with. All right, well, that's it. Call that a show. If you got anything out of this video, yeah, please like, subscribe, hit that little notification bell. Until then, have a great day and Happy New Year. Bye. So my daughter's been in town here for about the last couple of weeks or so, so I haven't made any videos. But she left yesterday, and so video today. Now, while she was here, I took her, the things that I like to do. I took her to about 10 pubs, but I also took her to see Tottenham Hotspur. That's a Premier League club down in London. Now, that's actually my wife's club. It's not my personal club. It's her club. But I took her there because, just to give her the Premier League experience. And then I took her to see Ipswich Town because we actually live near Ipswich, and that's our shared club. That's like the local club here in Bury St. Edmunds. And Ipswich has a very nice atmosphere. I think it's a great atmosphere. Come on! We want the League 62! So with that, guys, have you ever gone to sing with the local supporters in a car park outside of your favorite club stadium? Man, I have, but not before I've had at least 2 pints of my sponsor this week, which is cider. Now there's a curveball. It's all I have in the house. Gotta admit, kind of like that. This here cider is Strongbow. It's very common out here. People actually don't like it, like your cider aficionados would say that it's not very good. But I disagree, and I have to give this cider 5 Jumana Bersecchis out of 5. Have a great week, everybody.